Hello students, welcome to my class. This is Professor Vincent Osaya and this is part 3 presentation of chapter 4, completing the accounting cycle. This is where we left off. We completed objective 2 in part 2. Here we are going to explain the purpose of journalized and post-closing entries. Recall, we established the fact that the financial statements are prepared in a very systematic fashion. In other words, financial statements are not created haphazardly. You cannot perform step 6 until you are done with steps 1 through 5. So, moving along, thus far we have talked about several steps relative to the process of completing the accounting cycle. And what do we call this process? The process is called accounting cycle. That is the process for preparing financial statements. Now, here are additional steps that are needed to wrap up this process. The main thing here is we are going to close some accounts. What does that mean? What does that mean? Closing accounts means making those accounts to be zero. In other words, we are zeroing out the accounts. Now, you need to catch this. We are not closing out every account, we are closing out some accounts. The question is why? Because at the end, we close out some accounts at the end of the accounting period so that we can start afresh, or so that we can have zero balance at the beginning of the next accounting period. So it's important for you to understand that. Now the question is, what is accounting period? What is accounting period? Recall, we talked about that extensively in chapter 3. We said that accounting period is the period for which financial statements are prepared. In other words, how frequently does the company need financial statements? In other words, how frequently do you need to know how well your company is doing? Monthly, then your accounting period is every month. So you have to go through the accounting cycle every month. Quarterly, then you have to go through the accounting cycle every quarter. So I ask my students, here's a question for you. Assuming that you inherited $500,000 from your grandfather, and that is all you got, $500,000. But you choose to complete your education here at Chicago State University before you move out to California, because one of your friends in California is operating a business and he was able to convince you to invest the $500,000 that you just inherited from your grandfather. So you are here in Chicago and your friend is operating the company in California with your $500,000. Question to you: how frequently do you need to know how well the company is doing? How well things are going in California? Monthly, quarterly, yearly, every 5 or 10 years? How frequently do you need to know? Of course, very likely you need to know every day. All right? I mean, of course, you have to give your friend an opportunity to operate the business. So, at the minimum, we said monthly or quarterly, but everybody has to go through this accounting cycle at least once a year, because of the federal government. The Internal Revenue Service says you need to get it together and figure out how much profit or net income you make in order for them to determine how much check you need to send to them. Let me not digress too much. Bottom line is, what is the closing process? What are we closing? First of all, we indicated that we are closing some accounts that need to be closed at the end of the accounting period. Now, which accounts do we close? revenues, expenses, dividends. We call those accounts temporary accounts. Why do we close them at the end of the accounting period? So that we can start with zero balance in the next accounting period in order for us to track and report our performance in the next accounting period. See, revenues and expenses for January, you keep track of them, you zero out the account and start afresh in February, you start afresh in March, so on and so forth, assuming that your accounting period is monthly, all right? So we close out these accounts and we call them temporary accounts, all right? Now, here are the accounts that we don't close out. We call them permanent accounts. How come we don't close out these accounts? Because by nature, these accounts are permanent. Let me give you an example. Let's assume that assets, liabilities, equity by nature, they are permanent. Let's give you an example. Let's assume that you gave your friend $500 loan in September. Then January or the following year, you ask your friend, hey, can I have my $500 back? Your friend said, oh, it is the beginning of a new year. I just close out the account and start fresh. No. As far as your friend is concerned, your $500 loan is a liability to your friend, and your friend cannot close it out at the end of the year or at the end of the month, whatever the accounting period is. It continues in the next accounting period until that your friend pay off the amount. Same thing with assets. Can you imagine going to the bank on January 2nd and you say, well, I need my money, but the bank said, oh yeah, your $10,000 in the account is now zero because we close out our books in December. No, they can't do that. It carries over. Now, that being said, let's take a look at additional issues relative to closing. Now, how do we close these accounts? We already talked about the accounts that we close. Revenues, expenses, and dividends. By closing the account, we are going to transfer the account temporarily to an account called income summary. Income summary account is used temporarily for the purpose of closing. By the time we are done with our closing, in other words, closing the accounts that we need to close, income summary account will be gone. So let's take a look at this process. Here are the 4 steps of closing. Now, don't confuse these 4 steps with the bigger steps of the accounting cycle, okay? These 4 steps are sub-steps of one of the steps of the accounting cycle, all right? So let's take a look at how this works. Number 1, step of closing. You close out revenues accounts into income summary account. What does that mean? What is the normal balance of revenue account? The normal balance of revenue account is credit. So to close it out, we need to debit it for the same amount. So if we have a credit of 10,000, you debit it 10,000, the account is zero, you close it out. So if you debit revenue account, you have to credit another account. What do you credit? You credit the income summary account. Remember now, income summary account is used temporarily for closing purposes. Then let's take a look at step 2. Step 2, we close out expense accounts, or the expense account. Now, the normal balance of an expense account is debit. To close it out, we have to credit it for the same amount to close it out. So if we credit an expense account, we have to debit another account for the same amount. So in this case, we debit income summary account. So you need to catch this. So after step 1, step 2, income summary now have revenue, expenses, total amount. So the difference, of course, is credit, because if revenues are more than expenses, the difference will be a credit balance. So, and of course, in such circumstances, that is net income. The opposite is case is net loss. Now, the third step is we have to close out income summary account, because the income summary account is used temporarily for closing purposes. So because income summary has a credit balance, to close it out, we need to debit income summary account for the same amount to zero it out. So when we debit income summary account, income summary is zeroed out. Now, if we debit income summary account, we now have to credit another account. We credit retained earnings account. So that increases retained earnings account. Then the fourth step is to close out dividend account. The normal balance of dividend account is debit. To close it out, we credit it for the same amount to zero it out. By crediting it, we have to debit another account, and we debit retained earnings account. So here you have it for the closing process. It's a 4-step process, and you need to commit that into memory, because it is going to be on your exam. Now, let's take a look at each step on each slide. So this is, now don't forget, now when you do closing entries, you are recording the transaction in journal. Remember, we indicated in chapter 2 that every transaction has to be recorded first of all in the journal before we post to the ledger. So I really don't like how they position this slide, because this is supposed to be number 1, because we journalize it, we debit revenue account to zero it out, we credit income summary, and after we do that, then we post to the ledger. Remember, the T account is a substitute for ledger, all right? So here you have it for step 1. Now, same thing for step 2. So step 2, look at what happened. All the expense accounts are credited to zero them out. The normal balance is debit. By crediting them, you are zeroing them out. Then of course, we debit income summary. Then step 3, we close out the income summary into retained earnings account. Then step 4, we close out dividends into retained earnings account. So as you can see, retained earnings is now 0. If we go back to the previous slide, income summary is now 0. If you go back to the previous slide, by crediting all the expense account, like I indicated, the expense accounts will now be 0. So here you have it. Here is a summary of the 4 steps of closing in form of a journal entry. Okay, journal entries, 4 steps. You need to understand it. Close out revenue into income summary, close out expense into income summary, so on and so forth. Now, closing temporary accounts, net loss for the period. This is important. If we have a net loss on the income summary account, the debit will be more than the credit, because here you have the total expenses, total revenue. So in such circumstance, the balance of income summary will be debit. If it is net income, the balance will be credit. So to close that income summary account, if it is a net loss, you have to credit it to close it out. Then in such circumstance, you have to debit retained earnings. I know I'm throwing a lot at you right now, but you have to go through this multiple times for you to be comfortable with this. So This is the conclusion of part 3 of chapter 4 presentation.